Governor Miran, thank you so much for sitting down with me. It is great to have you on the program.
Thanks for having me.
We've gotten a new reading this morning on private sector job growth, and we're seeing that job growth swung positive in October to 42,000 from negative 29,000. A lot of that job growth coming from larger companies as opposed to mid-sized and smaller companies. How are you looking at this report? And given that we don't have official government data, how is it informing your outlook for the labor market?
Sure. So, we always have to be cautious about reading too much into any one report, and that's going to be even more the case when we have a government shutdown, that we're not getting the data that we need to make monetary policy. Now, we are getting alternative data from a variety of sources, like the data that we got this morning from ADP, which is a welcome surprise that it came in a little bit better than expected. But in the context of the overall picture of the job market, it seems like the pre-existing trends that were in place before the government shutdown in the labor market seem to be continuing, at a similar rate. You continue to see, modest potential overall job creation. You continue to see moderation in wages, and you continue to see indications that labor demand may not be as strong as we'd like it to be from a cyclical perspective. All of that, to me, is an indication that that rates could be a little bit lower than where they are now.
How much of this that's driving the job market right now is structural versus cyclical? We know there have been major policy changes that have come from the administration, which take time to work through the economy. What's your sense of that? And do you have the tools, if it is structural, to deal with that?
Yeah, so a lot of the changes to the number of job creation, to the levels of job creation that would occur as a result of policy changes like immigration are what we as economists would call output gap neutral, right? Economically, the role of monetary policy is to balance supply and demand in the economy, and to make sure that you don't have demand so far outstripping supply that you get, upward spikes in inflation, or that demand isn't cratering relative to supply so that you get downward spikes of deflation of the type that you have in a depression-like environment. And so the goal of monetary policy is really to balance supply and demand. Now, if you have changes in, let's say, population growth because you either have a policy of large-scale mass immigration or you have a policy of closed borders and net zero migration, that's going to be what we would think of as typically, in my opinion, output gap neutral. And the reason that's the case is that when you have an additional person in the economy, they're generally consuming as well. They're working and they're consuming. And so from an output gap perspective, it's not clear that there's a very big role for monetary policy to play, because it's not the case that supply or demand are moving by very different amounts. They could be moving by very similar amounts. And so some of the low levels of growth are a result of changing border policy. If you have an economy in which you're throwing in large numbers of new migrants, of course, the overall job number will be flattered by that. And if you stop that, the overall job number will reflect stopping that. But that's not necessarily something that monetary policy responds to automatically.
And sort of building on that, the president has gotten many companies to invest billions of dollars in this country. We're going to be seeing investments in technology, in AI, in factories at the same time. The tax bill has been made law. We've got 100% expensing on PP&E and factories. How much job growth could we see from that? And what is the timeline on that? Is that a 2026 story? And again, kind of going back to those longer term structural versus cyclical trends, how are you viewing that as it relates to the labor market and setting policy? Yeah,
so look, I do believe that the supply side of the economy matters, right? I don't exclusively look at either just the supply side or the demand side. I think that they both matter. And as I said a moment ago, the role of monetary policy is to balance them. And I think that there's a whole slate of expansionary policies on the supply side that drive out the productive capacity of the economy. You mentioned some of them, things like the full expensing provisions from the tax bill that was passed over the summer. There's now a huge tax incentive to invest in new factory equipment or to invest in factory structures. I do expect that to result in some additional investment demand. That additional investment demand pushes demand up higher in the short run, and a little bit longer run, it pushes the supply side of the economy out because you can produce more because you have more capital. And that's all stuff that matters when you think about the outlook and when you think about where monetary policy should be. But there's other elements that are pushing out the supply side too, and think about regulations. Regulations really shape the structure of the economy because they decide whether you can produce or not and what you can produce or not. So the industries that you have in the country, how big the industries are and where they're located, can all be a function of the regulatory environment. And as you change those, you can change the supply side of the economy too. And pushing out the supply side of the economy in those ways, and sometimes it'll take demand with it. For instance, and when you the full expensing, right, will create investment demand. But in other things like regulations, it's not as clear to me that it pushes out the demand side as well, and it actually expands those output gaps that I mentioned a moment ago that monetary policy should respond to. So I think there's a variety of policies that are affecting the economy. They affect the short run, they affect the long run, they affect both of them, and they affect the supply side and the demand side. And it's really important to be thinking about the ways in which those are happening and trying to disentangle them and how monetary policy should respond to that. And we typically think about monetary policy as responding to three things. It responds to the output gap that we talked about. It responds to the outlook for inflation, which can also be affected by these policies, and it responds to changes in the so-called neutral rate. That's the level of monetary policy that's neither restrictive nor accommodative. And so you'd want to be looking at all of these policies and trying to say, okay, what's it doing to each of those three things?
Switching gears, the Supreme Court is hearing oral arguments this morning about whether President Trump had the authority to issue tariffs under emergency economic powers. Under those powers, we've seen many trade deals cemented. The U.S. has pulled in nearly $200 billion in tariff revenue as of September 30th, 2025. If the High Court were to rule that issuing tariffs under those authorities were illegal, and I fully recognize that the administration is working on contingency plans, but what would that mean for the impact on the economy? Would that increase uncertainty, pressuring growth and hiring?
Yeah, so absolutely, something that would affect uncertainty would something that would increase uncertainty over the tariff environment, over the trade environment, is absolutely something that could be a drag on the economy, and that might come as a result of the deliberations you referenced. That type of drag on the economy normally would, all else equal, depending on how the Fed is doing on hitting its two mandates of price stability and maximum employment, but all else equal, in addition of uncertainty from something like that, is something that you would think of us as normally offsetting with moderately looser interest rates. And there's been other sources introducing trade uncertainty in the recent past too. We recently just had another little trade confrontation with China that resolved favorably for the short run, but we'll have to see sort of the durability of something like that as well. But also, the revenues that the revenues that you mentioned matter because the amount of savings in the economy sort of ties back to monetary policy for thinking about where we set interest rates. And if you have an increase in national savings, it normally is the type of thing that would lead to lower interest rates, along lines that I discussed in a recent speech of mine that I gave a little bit over a month ago. And if that revenue were to go away, then you would sort of naturally think that would have implications for interest rates that would be of importance to monetary policy.
You dissented for the second policy meeting in a row last week, preferring to having cut by 50 basis points instead of 25 basis points. You said you don't think that tariffs are leading to higher inflation, and you'd like to get to a level of neutral on the Fed funds rate faster than your colleagues so as not to do undue harm to the job market.
Yeah.
Are the economy and the labor market at risk given the pace with which the Federal Reserve is proceeding at this point?
So, look, if you look at the summary of economic projections, I think that that most of my forecasts are not really, or most of my projections for where the economy and inflation will go and the appropriate policy that would reflect those, are not that different from, I think, where a lot of the rest of the committee is. The significant difference is that I want to get there faster than everybody else does. It's not that the destination is really all that different. It's that the speed with which I want to get there. And part of the speed with which I want to get there is a result of the inflation outlook. I'm more sanguine on the inflation outlook than a lot of my colleagues are, in particular because I don't view tariffs as driving a material amount of inflation, but also because I see shelter and housing market inflation coming down more quickly than many of my colleagues do. That said, to your question, I think policy is too restrictive and that we're too far above where neutral rates would be. And given the state of the labor market, I think that continuing to run policy that restrictive is to also run unnecessary risks. And there are lags with this monetary policy. It's the economy. If policy is that restrictive, the economy doesn't crater immediately. However, if you keep policy that restrictive for a long period of time, you run increasing more and more risks that those lags catch up to you and that monetary policy hits the economy in a really unfavorable way.
To your point, Treasury Secretary Scott Bessent said over the weekend that he believes that there are parts of our economy, particularly housing, that may be in recession already right now because of high interest rates. Do you agree with that?
Well, I think there's always going to be parts of the economy that are relatively stronger or relatively weaker. That's always going to be the case. But we were tasked by the Congress with targeting maximum employment and stable prices in the economy as a whole, and so it's not really appropriate for us to sort of respond to a particular sector of the economy that may be in more or less distress than other sectors. We want to think about the economy as a whole. And I'll go back to what I said before. If we keep rates this restrictive for a long period of time, you increase the risk that the restrictive rates themselves, that is that monetary policy itself, is what causes a downturn in the labor market of exactly the type that we were tasked by the Congress with avoiding.
Chair Powell said that a December rate cut is not a foregone conclusion. In fact, far from it. And he stressed that there's a lot of division on the committee right now as it relates to risks as they view inflation and the job market. What's your sense from the meeting, again, your sense of whether it's going to be an uphill battle to convince your colleagues to cut again next month, let alone cut by 50 basis points?
Well, look, I speak for myself and not for anyone else. But, I think that if you go back and you look at the summary of economic projections that we put out after the September meeting, the median forecast was the median projection was for a third cut this year, meaning a cut in December. So I think the natural question that would follow from that is, has anything changed that would make you change the way that you think about the appropriate policy stance? And the new information that we've gotten since the September meeting, which is not as much as we would like because of the government shutdown, but the new information we've gotten has been, one, that inflation has actually come in below where expectations were for the September CPI print that came out recently. And two, that the labor market continues to be, based on the alternative data that we have, the labor market continues to be on the trend that it was. So given those two things, I would think that it would be consistent with the September summary of economic projections to increase the odds rather than decrease the odds. But that would be according to the median of those projections. And so if that were serious, then I would think that the odds would have gone up. And again, anything can happen between now and December. There could be new information. There could be surprises. There could be shocks. Things that we don't expect could occur. You've mentioned several possibilities. But barring new information that would make you really change your forecast a lot, I would think it would sort of still be a reasonable, consistent, a reasonable action consistent with that step to continue on the path that we've been on.
Let's talk about inflation, because the latest CPI report showed that housing inflation actually dropped, which goes to your point that as you expect lower immigration, that will push down demand for housing, bringing down overall inflation. However, services seemed to move sideways. Core services inflation has been running closer to 4% over the past 3 months. So how are you looking at that? Because that's not tariff related.
Yeah, so I viewed that inflation print as consistent with my expectations and as bolstering my case, because so much of my case does rest on housing coming down and shelter disinflation being enough to compensate for some higher run rates in other parts of the index. But that said, if you look at the non-shelter services, I think that it's important to sort of say, okay, what are these services? And the way that the Bureau of Economic Analysis calculates the price index on personal consumption expenditures contains some things that it might not be natural to think of monetary policy as targeting. And so we spoke before about how monetary policy balances supply and demand. And there are what we call imputed services in the PCE index. Things like financial services, like portfolio management fees. And the way that gets recorded in the data that the BEA constructs are that if the stock market moves higher, then portfolio managers, asset managers, so forth, they're collecting more fees on the assets they're managing because the value of the assets has gone up. That gets recorded as a price increase in the inflation data, even though you might think of it as more of a quantity increase. They're managing more assets, so therefore, they have a constant management fee. The volume of the assets moves up, and so the overall fee comes up because there's a higher base, but the management fee itself didn't really change. And yet that gets recorded as a price increase in the inflation data because of quirks of the statistical process. But it doesn't strike me that that implies a supply-demand imbalance of the type that monetary policy should respond to. Monetary policy shouldn't mechanically respond to an increase in the stock market that could be driven by any number of things. It could be driven by a new technology, like AI. It could be driven by a government policy like removing regulations. It could be driven by any number of possible things that monetary policy might or might not want to respond to, but it shouldn't want to respond to it because of the stock market. Once you remove some of those imputed services like that, and you look at more of a market-based core services or market-based core PCE inflation, it's much closer to 2%. It's like 2.3, 2.4, depending how you slice it.
Before I let you go, Governor Miran, is there a line in the sand on inflation, whether it's CPI, PCE, inflationary environment, that would change the trajectory of getting to the rate of neutral that you see at 2.5%? Or is it that you're saying we should get to 2.5% as fast as possible, and if inflation is not coming down, then we adjust upwards?
Yeah, so as I've said in the past, shelter inflation is such an important part of my outlook for a couple of reasons. One, it's the biggest weight in the indices. Two, it's the biggest weight because it's the largest expense for most people is going to be their rent or their mortgage or whatever. And so, that goes into how people think about the cost of living and how people set their inflation expectations. The cost of housing is really important for people thinking about the cost of living. And my expectations for shelter inflation are extremely benign because market rents have been running at about 1% on a weighted average basis for several years now. And so it's only a matter of time until the official data converge down to the market data. And I think that process is underway, and the recent inflation print, I think, bolstered that view. Now, my view is that the shelter disinflation is enough to compensate for some higher inflation in other segments of the index. If something were to change that made me change my view of shelter disinflation to say, hey, there's a housing shortage again. Rents are moving much higher. The rent, there's going to be a huge increase in rents from where they are now. Rents have been relatively constant, running at a low 1% rate, and that low 1% rate is going to turn into 2, 3, 4%. Then my entire forecast needs to be updated as a result. And if my entire forecast needs to be updated as a result, then I need to change my policy outlook as well. So for me, a lot of my outlook is hinging on this. And if there were some piece of news or data that made me revise that, then I would make that revision, and I think that would sort of flow through my entire outlook into the policy projections as well.
Governor Miran, we'll have to leave the conversation there, but thank you so much for your insights. So appreciate it. Hope you'll come back and see us soon.
Of course, thanks for having me.